Hello and welcome to the day ahead. It is Tuesday, March 29th. I'm Nadine Blaney. Kicking things off locally as we count down to the release of the federal budget tonight, with SPI futures sitting up 0.5% this morning around the 7,400 level. We are expecting to see support coming through from miners and financials, though a spike in bond yields capped the gains in yesterday's session in New York. Back to the budget and what's expected from the pre-election papers, and a cash splash is expected from Treasurer Josh Frydenberg, with an eagle eye on reducing the rising cost of living pressures from a fuel excise cut to bring forward changes to the childcare subsidies. Here's what we know. Analysts are expecting a turnaround to the bottom line, with the deficit penciled in at around $70 billion, a decent improvement compared with the $99 billion, which was forecast by the government's MyEFO report back in December. An unemployment rate is forecast to be around 3.7% by September of this year. Debt, though, will creep closer to $1 trillion, with a warning big spending could overheat the economy by driving up inflation. Low and middle income earners, those earning under $126,000 a year, will receive a one-off cash payment rumored to be around $250. A cut to the fuel excise, reportedly between 5 and 10 cents. It currently sits at 44 cents per litre, alongside $50 million to shore up local gas supply, will hopefully bring the cost of petrol down, at least in the government's estimation. The home guarantee scheme will be doubled and extended. We're also expecting to see a $15 billion boost to defense spending, including support for Ukrainian military forces, and a close to $18 billion boost for infrastructure spending across the nation. Now, in terms of bringing forward that childcare subsidies, it looks like the changes will be from July 1st to March 7th, and estimated to cost around $24 million this year and $670 million a year going forward. Plus, we're expecting a further $1.2 billion over 4 years to expand the transition to work, which is a push to ramp up skills amidst a nationwide shortage.
Dealing with one of the most severe skill shortages in the Australian labour market really in the past 50 years. Got an unemployment rate which is hovering on 4%, tipped to go lower. So we're at or almost beyond full employment in the current circumstances. If we want to avoid a situation where there's more pressure coming through in terms of prices, obviously wages have still got some upside to go, but I think if we want to avoid these supply side constraints in the economy, then we've got to have an integrated strategy to address labour market shortages. Investment in skills is a critical part of that.
Now, elsewhere on the watch list today, oil ending the overnight session down more than 7%, breaking below the $106 a barrel handle, falling further in post-close trading by as much as $11. The bears returning over renewed China lockdowns and worries over high prices crippling demand, so that old demand destruction scenario. Metals and miners also took a dive as Shanghai plunged into lockdown to curb those rising COVID cases there. Nickel was trampled, down nearly 8%. Iron ore futures were marginally lower, with ADRs of BHP in Rio and New York down 0.9 and 1.9% respectively. Gold was also down after U.S. Treasury yields and the greenback rose. So summing it up, Wall Street ending on a pretty solid footing, higher for a third consecutive session as a spike in Tesla more than offset weakness in energy amidst those falling oil prices. Tesla shares soared after it revealed plans for a second stock split in the form of a dividend. This as Russia and Ukraine are poised to hold the first face-to-face peace talks in over 2 weeks. Now, the rise of U.S. Treasury yields took a breather as oil fell on fears of that weaker Chinese demand. Worries of a recession, though, do remain in the rearview mirror for investors, with the yield curve between the 5 and 30-year briefly inverting for the first time since early 2006. For markets, though, now it's all about the technicals after the S&P 500 found resistance at 4560. Analysts expect a break above that level. We'll see a flurry of buying, which could challenge that early January high of 4,800. Globally, stocks wavered slightly with the MSCI gauge of stocks down around 0.2%. European equities were mixed, with those Chinese lockdowns weighing on sentiment. And the brutal sell-off in government debt continued, with the Dutch and Belgian two-year bond yields turning positive for the first time since 2014. Also, the Bank of England moving less aggressively, according to its governor, on monetary policy going forward, and that, again, put pressure on bond yields there. Let's check in on the currency space, and it was all about the yen skidding over 1% and holding at a 6-year low against the USD after the Bank of Japan intervened to stop government bond yields from rising above its key target, so still in that yield curve control scenario. The Aussie was also lower off the back of that drop in commodity prices. And let's end with a bang. Bitcoin up nearly 2.5% to hit a year-to-date high of 47,997. That's its highest level since the end of December. Traders now eyeing the 200-day moving average of 48,291 for a signal of what's to come. Well, that does it for the day ahead. I'm Nadine Blaney. We'll see you tomorrow.